Fund Supermart, your online gateway to unit trusts.
Hi Veronica. The LionGlobal Asia Bond Fund has had quite an impressive track record since its inception and on a year-to-date basis. What were the main drivers of the fund's performance since the start of 2016?
Since inception in 2009, the LionGlobal Asian Bond Fund has returned 7.4% per annum in US dollar terms. The returns are from two main sources. Firstly, the coupon carry from each underlying bond, and secondly, capital gains from interest rates moving lower. This year, the portfolio dollar returns is quite good at 9.1% for the 8 months to August 2016. Post-Brexit, there was a sharp rally in risk assets globally. The price rally was from strong demand arising from a chase for yields, amidst expectations of more quantitative easing by central banks globally to cope with Brexit uncertainties. US 10-year Treasury moved to a record low of 1.35% in August. There were also record weekly inflows into emerging market debt in July and August. As a result, credit spreads tightened on the back of strong market technicals. This confluence of Brexit uncertainties, strong investor demand, and good fund flows contributed to the 9.1% dollar returns for the fund.
Which sectors or countries within the Asia region do you see most potential?
We like Indonesia as a country that should benefit from the story of the stabilization in oil and commodity prices, and it also presents a sector to add duration. The oil and commodity sectors have lagged the rest of the market in the recent recovery and still offer some value. Secondly, bond supply in countries like Singapore, Malaysia, Hong Kong, and Thailand have been low, and credit spreads in these countries should hold up and serves as a good hedge against market volatility. The third one is China. China is dominant issuer in the dollar credit markets. In China, high-grade government policies continue to favor state-owned enterprises in banking, energy, infrastructure, construction, power generation, and gas distribution. In China high yield, China property bonds are trading expensive versus their historical levels, but still provide good risk-adjusted carry relative to China industrial high yield space. One important consideration on buying China is that the technicals for the more established Chinese companies tend to be very well supported by onshore Chinese accounts buying, which provides a floor for downside risk. In general, for the portfolio, we prefer defensive sectors that should maintain their stable credit profiles even if the macro deteriorates.
Why is it a good time to invest in Asia bonds funds now?
The main theme for investing in a bond fund is to clip the coupon over the medium term. Asian bond funds provide a yield carry of 4% per annum with a duration of around 5. So this level still is considered a decent carry if you think global interest rates will remain low for longer. With the data points from US coming in mixed, European economic growth momentum still tepid, and Japan's inflation targets still not met, and you have uncertainties around Brexit, there seems to be little ground to precipitate aggressive rise in interest rates. We think central banks are likely to keep policy rates low for long. So if interest rates in Europe and Japan continue to stay negative and US interest rates are positive, there will continue to be demand for dollar assets given this interest rate differential. This makes dollar corporate bond a feasible investment.
With impending US interest rate hike, should investors in the fund be worried? What kind of impact would it have on the fund?
Indeed, rising interest rates is a key concern when investing in the bond fund. When interest rates move higher, the erosion of bond prices will negatively impact the total returns of the bond fund. Markets are expecting US Federal Reserve to hike policy rates when they next meet on 15 December 2016. What is more important than the one rate hike is the Fed's guidance for further rate hikes in 2017. We expect the Fed rhetoric to be measured, we expect the normalization of interest rates in US to be a gradual process. So long as interest rates do not rise very sharply, the coupon carry from the corporate bonds can cushion to some extent the price erosion from interest rates ratcheting higher and sustain positive returns for the fund. Recall US Fed's first rate hike on 17 December 2015. We are almost 3 quarters into 2016. Yet, US Treasury yields have on the contrary moved lower by 65 basis points across the curve instead of moving higher. If the market is prepared for one rate hike and is not taken by surprise by unexpected events, market reaction should be well contained, and we do not expect a major sell-off in bond markets for the rest of the year.
What differentiates the LionGlobal Asia Bond Fund from its peers?
The fund has a long track record of delivering consistent performance and outperformed the Jackie benchmark over a 5-year period and since inception. On peer ranking, it remains within first quartile and has won a few awards for performance since inception. The fund's performance is backed by a deep and experienced bench of expertise with strong commitment by the firm to the products.